Good day, everybody. Good afternoon, evening, or morning in the case of you guys in the US. Welcome to our launch for the Accretiv hybrid portfolio. I'm sure there are lots of questions out there today, so let's jump into it. And firstly, if I can just welcome our panel, John Trabold, who's currently very kindly given us his time. He's sitting at a wine farm on holiday somewhere in the US, and of course we've got Martin in New York and Michiel in Atlanta, and myself here in South Africa, and Justine is organizing everything in the background. Just a disclaimer for everybody's notice, just bear in mind this is for information purposes only, and it is the responsibility of you to get prior independent advice before making any investment. And then of course Orbest SA, who's presenting this, is an authorized financial services provider in South Africa. So just to go through the webinar agenda today, first of all, obviously, why the switch from healthcare to small bay industrial real estate? And I think no better person to talk about it than somebody who has spent most of their life in the healthcare space than John, but I'll leave that to Martin to do the introduction. Obviously, then we will run over our strategy on how we plan to do this and to take advantage of this opportunity that is there in the market at the moment. And of course, we will go into our first building, and we do currently have 2 buildings under contract already for this particular portfolio, but the second one is still undergoing due diligence, and so we are presenting the first one, 1441 Branding Avenue. Then we will go through all the details of that particular property. We'll conclude with some questions and answers from yourselves. There's a fantastic turnout tonight, so thanks everyone for joining, and without further ado, Martin Freeman.
Justin, thank you so much for the introduction, and welcome to everyone from around the world. Great turnout. And so as we move into the first part of the presentation tonight, it is my absolute joy and honor to bring in John Trabold, who is a good friend of ours. He is well known in the real estate industry across the US. He's got, I can't even say years, decades of experience, assessing the viability of deals for most of the large REITs and the large players in the United States. We've gotten to know John through the medical office conferences that we've spent time at. And the couple of deals that we've given John, I must say that the assessment and the feedback he's provided has been absolutely spectacular. And so off the back of that, I'm going to start to hand over to John. But one of the things that you'll be asking is, why is John also on tonight? Because I said to John, listen, as a trusted advisor, I want you on with our entire team as we start to set the industrial and the move to it. And he was extremely complimentary of our strategy, and he was aligned with our thinking and what he's seeing and experiencing himself in the United States right now. So, John, without further ado, over to you. You can explain a bit of your background, and on to you.
Sure. First of all, I have to give kudos to whoever designed this photoshopped picture of me, because I look about 10 pounds lighter, and it's very exciting to see that. And I think they're just trying to drop a hint for my next conference speaking opportunity that maybe I need to get on the treadmill a little bit longer. But with that being said, my name is John Trabold. I'm an MAI, which is a commercial real estate appraiser, and I have been managing director of VMG Health in their valuation arm for the last decade. I've been a partner there, and I've also, prior to that, I represented a lot of the largest retailers in the United States, as well as several REITs, ranging from Target to Walmart to CVS Pharmacy. So I've got a long, extended background, and frankly, the reason that I have been involved with Orbvest now probably over the last 7 years is that I think that you've got a winning team. I think that, I enjoy working with Martin incredibly, and Michiel and Justin, and I think that they're professionals. I think that they're thorough. And one of the things that always, besides just enjoying life, I think it's important that when we go through things, that they listen more than most people, because it's very easy to get involved in your own deal and fall in love with your own deal. And they certainly have the patience and the resolve to listen to all points, because they know very often I present news to them that they may not want necessarily, but I think that I present it in earnest to them based on my experience. So I've been involved in the healthcare industry over the last 12 years, over 10 years, in valuing some of the largest assets across the United States, ranging from de novo surgical centers all the way to hospitals. And when Martin and Orbvest started really getting their toe in this pool, I think that it's difficult because healthcare is incredibly complex. I think that it takes an understanding not only of real estate, but you have to have a true understanding of the operational end of healthcare, which is, it's an overwhelming task. So you really have to be able to focus on what you want to do in healthcare. And the climate is constantly changing, as it is across the world, really, with healthcare, because it is political. We like to say things aren't political, but healthcare is very politically driven in the United States. It's driven by reimbursements. It's driven by health care plans. And you have to have an understanding of that before you even understand the real estate. So when Martin approached me probably close to 6 months ago, 9 months ago, he said, we've got this idea we want to bounce off you. How do you feel about industrial real estate? And to be honest, I was giddy, because I think that industrial real estate has always been a segment that I personally have trusted, because I think it's low-hanging fruit. I think that because it's industrial, just the name, the moniker industrial, makes it so that it's not attractive. It's not, I hate using the word sexy, but it's not sexy. But what it is it's stable, it's easy to run, it can be managed efficiently, and it's got opportunity for increases in revenue streams. So when it was brought to me, I asked them immediately. They said, I want to go into industrial real estate. And we kind of talked through this, and they have been working on trying to be very specific and target oriented, because industrial real estate covers 25 different types of property types. And so by understanding 2 or 3 of those types, do you want to be in logistics? Do you want to be in manufacturing? Do you want to be in older, newer? There are a myriad of things, but I think that right now Orbvest is really focusing on what they think will fit within their portfolio best, which will make it easier. And in the future, I intend to try to show them some possible opportunities of some deals that I may be aware of. I'm not a broker, so I don't do brokerage. I just do consulting. So I want to make that super clear that I don't benefit directly financially on commissions or anything like that. So my motivation isn't to assist Orbvest to make myself more economically whole. It's to provide consultations and to let them know, I'm shooting because this is how I see it at this point. So when we started going through some of these things, I think Martin would like me to kind of tell everyone why I think that industrial is low-hanging fruit. So first of all, industrial, there's always going to be need for industrial properties. And as we see what our current administration is attempting to do, we're attempting to do what our country, for the benefit of our country, has been trying to do for a long time. We're trying to take away all this outsourcing that we do globally and bring it back home, so that we can kind of control our own economy a little bit. And by increasing manufacturing, that will drive industrial demand. Demand for industrial has always been 90% plus in terms of occupancy. Rental rates have been really easy to read. And I think that because of that, because of the future pent-up demand, as we start moving jobs more into the United States, we're doing just tons of big manufacturing jobs in the state of Texas right now, especially in Austin, where we used to only do chip plants in China or India, and now we're starting to move everything here. And of course, you're going to have all of these suppliers that are going to be needing smaller bay areas that will be able to control the flow, and all of these satellite businesses that will benefit from our manufacturing, because our manufacturing base is going to increase. There's no question about that in my mind. That's what we're attempting to do. I think it's sound economics, and I think it's something that's really, really important for the future of our country globally, to be able to be less reliant on other people's politics and more on our own. And so with that being said, I just love the industrial market. I think that, Martin and I were talking about, traditionally, when we look at tenancy, because we're looking at the rents from industrial users, you've got users that usually sign much longer leases than they do for office or for retail. They, much like the medical field, they don't like to move. Once they are there, a lot of these industries will bring their own personal property and their own equipment and their own processes into these buildings. And frankly, they're really hard to move. So when their lease comes up, they have to look at how long would we be down? What can we move it? Will we move it? And it just becomes more difficult for them. And I also think that industrial properties, because they've got longer term leases than the 3 years that you see in retail or the 5 years, industrial leases tend to go sometimes 5, 10, 7 years, 5, 7, 10 years. What happens is those tenants in there, when they come up for renewal, there has been in the United States a tremendous increase since COVID in construction costs, both in labor and materials, which is driving the cost of new build to suit industrial buildings to the point where we haven't seen them, where they're $10, $15 a foot, which is going to make more demand for the lower end, the existing properties. So I'm just really, really excited about it. I think that there's going to be a lot of opportunity. When those leases renew, you're going to have opportunity to actually increase your yields, because you're going to have to adjust to the market and say, if their rent was right now $4.50 a foot, going to $5 a foot isn't going to be a big deal for them, but it's going to be a big deal for the investors in it. So I think that that's really, in a nutshell, why I'm excited to be able to talk about industrial real estate. And I'm going to do something I know I'm going to regret. Okay. I'm going to give you my email address. So if you have any questions offline, you can shoot me a brief email and I'll be glad to respond as quickly as I can. It's John, John, at traboldco.com, TRABOLDCO.com. And you can shoot me a quick, brief email, and I'll be glad to tell you exactly what my thoughts are. As long as Martin blesses that, I'll be glad to do that. And I'll just make myself available, because I think that, this is something that, there's a lot of passion behind this with the professionals that are putting this together. And I think they're entering a quietly very opportunistic food group in commercial real estate, and that's the industrial. It doesn't attract the huge REITs, other than, we've got some mega ones like Prologis, and take a look at their stock, see how they've performed. If you're trying to measure along the, Trammell Crow company's been very linked, and a lot of these long-term brands in the United States of traditional stable companies have an industrial background. And I think that, you could take a look at the performance of some of those groups, and you'll see why it's always been the backbone of a lot of these firms that are really the godfathers of real estate across the country. Martin or Mikhail, Justin, do you have any questions on this put together appearance?
It's great. I'm sure we all have. Might you start?
Well, firstly, John, thanks for that introduction. And, echo the sentiments. One of the things that I just want to also talk about tonight is really the escalations. And, we've been involved in, as you know, the medical field for forever. And, to get escalations of 2.5% has always been the norm. What really has been amazing is to see all the tenants in industrial signing 3 to 4% increases per year, which is quite standard and normal. And off the back of that, that's what creates your rental growth, which creates your rental income and your IRR. And ultimately, where we are at the moment right now with interest rates, the tailwinds are just incredible. So I believe that the opportunity, or we certainly believe that the opportunity is here for the foreseeable 18 to 24 months. And hence the reason why we would like to climb in right now, given the fact that there is certainly strong evidence this week that interest rates are about to turn the corner. What are your thoughts on what I just said?
Well, I think that interest rates are certainly going to be ticking down. There's too much pressure right now to keep them stable. I think that it's just something that has to happen right now at this point. So I'm not sure how far they'll go down. I think it'll be a 25 bip move at each point maybe, but I think that they're going to stabilize, which will put a ton of capital instantly in the marketplace, because I think it's going to signal a turnaround to a lot of people who are still hesitant on, we're starting to see some commercial mortgage-backed securities being taken back. So there's still a little bit of apprehension in the world, in the real estate world. We just, Martin, I know, is going to be aware of this. Our last quarter in the medical real estate field is the lowest amount of transactions that we've had in 10 years. So I think that's the statistic. And people are attracted to medical real estate simply because it's it diversifies their portfolio. So by going, by what we're looking at, I think we're kind of going a little safer, a little slower, and we'll be more opportunistic. But I think that the escalations, the 3 to 4% is something that has to happen. That's just now a part of doing deals in there. And you are also dealing with, and I don't want to sound unfair, a less sophisticated tenancy to a degree in terms of knowledge, because if you all had any background in dealing with retail people at all, every nickel is going to be squeezed. Every deal point is going to be painful. And I think with this, when you're dealing with companies in the industrial world, they're more concerned with getting their widgets out, to be honest. They understand that this is a cost that will be passed through. And I think that it's a little bit easier in terms of the negotiations generally with the tenants, because you don't want to pigeonhole everyone and say that they're less sophisticated. But generally, on a scale, I would say that they are less sophisticated than office or than retail. And I think it's, instead of arguing over, is it 3% or 4%, Martin will be able to say, hey, look, this is what CPI has been. We're not going to lose money on these. This is what CPI has been over the last 2 years. We're going to cut this at 3.5%. We think it's very reasonable. We want to keep you as a tenant forever and go on from there. So certainly, I think that that's certainly something else that will be, and as we come up for renewal, Martin, if they have any of the old leases who are at 2%, then you're even adding more value by switching it from 2% to 3.5 or 4%. So touche as always, Martin. Touche.
Absolutely. And John, one of the things that really attracted us to medical in the early days is we were dealing with, as you said, almost unsophisticated sellers. It was always the doctor who was selling his building. But unfortunately, that's changed over time. Now it's become the large players selling to the large players, and they can both hold their ground. Hence the lack of transactional volume, given where interest rates are, and everybody knows in the next 12 months, hopefully, it's going to be lower, and therefore prices will be higher. And so that's the reason why it's such a pleasure. Our first 2 transactions in industrial, literally, we're dealing with the owner of the business, or alternatively, the actual owner of the building himself, who's owned it, in this case, for 30 years, which is incredible. And that's the real opportunity. But maybe also to talk about the size of industrial in America versus the size of medical in your experience. Do you have any conjecture of it?
Well, I think that, basically you've got more variety in the industrial world, because you've got everything from, the new logistics centers that are being constructed for Amazon and those types of, industrial. So if we look at logistics, that's an entire different food group, where we're talking about distribution, where you've got 120 bays coming in and 120 bays going out across from each other, cross docked. And it's very simple buildings. Everything's rectangular, everything's clean, which means less maintenance costs for you all, by the way. But with those type of buildings, you can get millions of square feet, as opposed to going down and just getting 20 and 30,000 square feet deals that are all over the United States. So I think that there is certainly more of an inventory on industrial property than on medical property. And again, I think that comes to the demand of industrial just isn't that attractive visually or physically. It's more steady. It's as I said, I don't like the term, but I think it fits. It's less sexy. And I think, though, that it's always been the backbone of prudent investors. So I think that you've got flexibility on your size, that you could go from 20,000 to as large as your fund gets. And you can still take a look at the same fundamentals when you're looking at a small building as a large building. You're looking at good locations that are close to the infrastructure, so you can get your product from where you're developing it to the marketplace. And you're going to do it by rail, you're going to do it by plane, or you're going to do it by truck. But you want to have, good fundamental locations with good, easy, clean construction. One of the other things I think is great about industrial is that we tend to see that the office share of this is, sometimes 5% up to 25 or 30% on some of these, excluding flex buildings. And with that small amount, it's less money for you if the tenant does leave ever. So in medical, let's use that as a comparison real quickly, Martin. If a tenant leaves in one of your medical buildings and you have to retrofit that space, you're going to be spending $120 a square foot to get it ready for the next tenant. And it can become a bloodbath. With industrial, you're going to put paint and carpet maybe in the office, and you may spend $3 a square foot. It's very, very different. And again, it's the flight to safety. I mean, industrial buildings, it's how do you get a building ready for the next tenant? You hand someone a broom and say, sweep this out, and it goes. It's very, very different than medical tenants who want to design their own waiting room, their own lobby. They don't like that. You've got doctors who want different vinyl plank floors. They want different lighting. These tenants come in, they get out, we put someone else in. You're not going to put a ton of money in it. I think that's another big, strong positive in industrial, in the actual ownership of it, is the retrofitting, because it's something that's really important.
Yeah, John, just going back to the size, my understanding is that the industrial sector is roughly about twice the size of the medical size. So,
at least in terms of mass inventory, yes.
Yeah, so that was, I think, for me, quite interesting to see it, because we're now specifically focusing on that. And then I think we got a very good question here from Jayesh in the audience, and he's basically just saying, what do we expect the returns to increase after the tariffs initiatives now from Trump? Is there any front running that we can see coming from people that actually want to reposition themselves as a result of these political changes? We just want to get a feel of that.
Yeah, Mikhail, it's a great question, but I think it goes back to what I said in the beginning, without getting too political. Our government right now is trying to make us a more independent manufacturing economy. And all that does is they do need space. Industrial also, another quick sideways, is that with industrial, you're not as threatened. Industrial, you need people to come in to build things. This isn't a do home. You're not going to downsize because people are doing Zoom calls instead, like they are in office buildings across the United States, or working from home. In industrial, most of those businesses, there is no working at home. You're working at your place. And again, I think that adds security, where you don't have tenants shrinking and then maybe growing when things are better and then shrinking again, like we do in the current office economy. But if we look up, I can get you the statistics quite readily on what the inventory for industrial buildings are compared to medical, but it's staggeringly larger. Now,
when I was visiting the building we're going to discuss now, we specifically asked the question around COVID, and he said that the workers were pitching up every day right through COVID, no stopping. So there was no discussion. There was not even a topic.
No working Justin, from home.
If I can maybe just say one last question from you. John kindly said he'd come on from 10 minutes, and we've held him for much longer, and we deeply appreciate it.
I built that into my formula, Martin. You've done this before. Fool me once, shame on you. Fool me twice, shame on me. I knew.
So Justin, any further questions? Otherwise, we'll let John go.
No, I think, John, thank you very much. We really appreciate you being online. And basically, for anyone out there who's been asking why we're acquiring so few medical buildings, it's because John keeps telling us, no, this is the reason why this is not a great deal. So just to let you know that that's
you can thank me all later, I promise. I just saved you 200 basis points in your cap rates, and Martin knows that's a fact in the last 18 months.
Absolutely. John, thank you so much for your time. Enjoy your vacation, and we'll see you soon.
Thank you. Bye-bye, everybody. Thank you for letting me have this opportunity.
Right, back over to you, Mart. Perhaps you'd like to talk a little bit about some of the fundamentals that we've been looking at as well, or just a recap on what John said.
Absolutely. So, I just want to take everyone through the next part of our journey tonight. And that is just looking at some of the fundamentals. And really, it's just been amazing for us to see, the vacancy factor, the amount of space available in industrial has just continued to shrink since the start of COVID. The economy is still growing. And really, one of the biggest things and why you see a shrinking of the vacancy across all the niches is because of the fact that it's too expensive to simply build at the moment right now. If you look at any normal building where you're building at $250, $300, $400, $500 a square, and then you still have to rent it out, what it means is that your new building, you need to rent it out at a very high rental rate versus someone like us going and building or buying an older building and renting it out. So it's difficult for construction players to, number one, compete. Number two is the debt that they're paying on their construction at 7, 8, 9, 10% is just too high. And so what you've got is you've got this not a day that goes by in the US where Trump and the administration and all the sectors are saying, we want the factories back here. We want Apple to start bringing their manufacturing back here. And these large players, specifically me coming from, South Africa, the quantums, you just can't even compare. I mean, they just talk things on another scale. And when they come in with these enormous centers, like what's happened when Tesla moved to, for example, Texas, they bring ancillary services and just entire nodes that Michiel and I have been to a place north of Dallas, which is called Frisco. I mean, 10 years ago, the city didn't even exist. It is now a thriving, amazing city that is just full. Everything, start to finish, universities, suburbs, etc., colleges. And so this is the absolute tailwind in the US at the moment right now. Justin, on to the next slide.
Yeah, I think, Martin, just to put you in perspective, most of the people in the audience here today will be subject to a lot of the South African news, and it's very different to what's going on in the US in terms of what you guys are experiencing on the ground. And I think maybe you can just bring that through when you're having your conversations. This graph I really like because it absolutely highlights the fact that industrial is the lowest vacancy, completely opposite the office sector, which we are kind of aligned to. But I mean, this indicates exactly what we are talking about. And if you have an acceleration in demand for industrial space and you don't have the supply, what happens to the price per square foot? Well, obviously, it's got to go up.
Yeah, Justin, just to add to that, our medical portfolio is also run about 93, 94% occupancy, and it mirrors exactly that trend. It's just as if the people are just filling up the existing buildings so that they don't have to start building new. So we definitely also on the medical side down there, but we've seen now the industrial is actually a little bit lower, or actually less vacancy than the medical. So all in all points to what Martin alluded to, the building cost is just so much higher.
And, just Justin, you mentioned something very interesting, which Michiel and I can talk very strongly about. It frustrates me, the sentiment that family and friends talk about in South Africa, specifically and around the world, because the main used broadcasting service around the world is CNN. And in America, it's very important people understand there are two absolute paradigm shifts. There's one on the left side and one on the right side. It is absolutely black and white. And so CNN on the left is pretty much against the current administration, doom and gloom, a lot of negativity. And literally, you'll switch over at night to Fox, which is on the right-hand side, and everything's absolutely amazing. But the sheer fundamentals in the US at the moment right now, notwithstanding what the news media says, is that there is an enormous amount of tailwind. You can see it in the numbers coming from the Federal Reserve. So what is our strategy? Let's talk about that tonight. Our strategy is very simple. We want to go in and we want to acquire between 8 and 10 of these buildings. We want to put them together. We want to shut this little portfolio. We want to put a little bow on it, hold it for a certain amount of time, and then we want to either refinance, sell some of the buildings if we get great offers on them, or otherwise do something and get the rate compression and upload this to a large player. We have been in discussions with some of the large players that absolutely said there is a need for this. The problem for them is when you have billions and billions in your portfolio, you can't go buying a building for 5, 6, 7 million. It just doesn't work. In fact, most players in the US won't even get out of bed, but unless it's between 20 million and 50 million. And so what they need is they need players like ourselves who've said it in the past to go and aggregate a portfolio and then simply hand it off to them and get that premium and that cap rate compression. And so we believe that the first 2 buildings demonstrate that already. And now I'm going to hand over to Michiel, who will talk about this because Michiel's actually been to the building. And I'm going to be going to the building also. But Michiel's been there, together with our partner, Mark, and I want him to talk about personal experience and how delighted he was when he came back. Over to you, Michiel.
Thank you, guys. Just let me know. Don't know, the internet's cutting in and out a little bit. But needless to say, it was a fantastic discovery to find this building. Actually, through our search, we do quite a lot of searches on with the brokers and on the internet to get to these deals, and our relationships bringing in this. So finding a deal at 8.25 cap rate with a vault of 7 years, and in this specific case, a multi-tenanted industrial building was really a gem. So from that perspective, immediately, as we always do, get on the plane and go see the building. I was there with Mark, our partner in the deal, and we actually met with the sales agent and surprisingly enough, the actual owner of this building. This owner is an owner that is actually focusing on the traffic light systems in the United States, and he has got a huge business of that. And his reason for selling is really, he's held this property now for a long time. He's got a few investors, but he really would like to scale down his investment business and actually focus on his traffic light business. Because for me, I was extremely skeptical because of this. And then further to this, what I really liked is the integrity of the players that I'm dealing with at the moment. The seller actually had an additional offer even higher than us on this building, and he basically said he's honoring our agreement. Now, so from that perspective, it started off extremely well. We got the deal under contract, and we've got a 75-day period to close that. Let's just go back to the previous slide, Justin, if you don't mind. I think one of the things.
Michiel, sorry, I want to actually jump in here, and I actually want to mention that. So the seller actually received an offer of nearly 200,000 more than our offer. Literally a day after word got into the market that we had closed the deal with a letter of intent. And it was, quite honorable for the person to turn around and say, sorry, I'm not renegotiating. I've met the guys, I shook their hand, and I'm going ahead with the deal. And this is what we used to experience in our original medical niche. And this is what we're finding in these two deals. And so Michiel, continue, sorry.
Yes, I think on the face of these buildings, what I really enjoy about these buildings is that it's got brick facade, which really lessens the maintenance work. Chicago is known for snow, so from that perspective, I really wanted to make sure that we can deal with the snow. And so far, from the anecdotal experience that was shared with us, that's pretty much not a problem. I'd like to point you to the loading bays. That's some of the thing that we really would like to have on these buildings, especially where the trucks can back up there. And in this specific building, it's very useful for the tenants, which I'm going to show you just now. And it's a quite unique way of doing it. If you look at the bottom picture, you'll see a little shape where the bays are actually taken out of the building shape. And that really makes it in such a way that they can actually service all the tenants. So from that perspective, it's good. The location we'll get into that was fantastic. And then I think from our perspective, the height of 12 feet was good enough. We prefer sometimes a little bit higher, but relative to the type of tenants that's in here that does not need overhead cranes, we think that is absolutely suit to fit in this. And then obviously these tenants are all triple net tenants, meaning that they pay for all their own expenses, and therefore the HVAC units, the water, the electricity, even the fiber inside the building is all per tenant, which is obviously makes our life as a landlord quite easy. Okay, let's go to the next one. Yeah, so I will go. All right. So we go to the detailed tenants just now, but I think the other thing that really struck for us is the fact that it is located in the specific DuPage County. From our experience the last 10 years dealing with buildings in the United States, Chicago is notorious to have tax issues. So we were very sensitive to that. And we found out that this is in the actual DuPage County, which really eliminates some of the tax problems we know in other counties. So I think that was a major tick forward for us. The second major tick for us is the focus on the logistics and the location. And so from that perspective, this is actually in a very good spot between two major highways. And you'll see just the reason why. I'll get to that just now. And then obviously, in terms of importing equipment and logistics, the airport just remains key. So it's super quick. Actually flew almost exactly that route from the city center to the airport, which is shown down there. So from that perspective, the location just made absolutely sense. So I'm pretty happy with the location. From a Chicago perspective, we haven't been normally in the Chicago market, specifically for that tax reasons, but we saw that obviously that is now sorted out. The other major thing is that Chicago has been an absolute metro for industrial transactions. So when we started to understand the industrial market, we obviously looked at where the concentration of industrial is, and we have found Chicago to tick that boxes absolutely, and the rental growth is also faster than normal. So that also just positions as well. As we said, the business plan is if there is a renewal, we can potentially then increase the rate, because we very specifically are buying industrial buildings with long leases, but they've got as a start a below market rent, and that's traditionally just because of the normal CPI increases that might have not kept trend with the market demand, and that creates a gap. Right. The second thing that I was really happy with is that we found majority of the industrial light manufacturing buildings is actually single tenant buildings, and I was really attracted to this building from the sense that it's actually got multiple tenants. And when we go through the tenants, you will see they've been freaking forever at this property. So I will get into the specifics of each tenant just now, but I think I just want to allude here to the loading dock layout. As you can see, it's actually quite interesting that it can indoors have, let's call it a corridor, which then serves the loading dock for each tenant. And this makes it extremely useful, especially if the weather is not good. So from that perspective, the trucks can back up. You saw the previous photo, or yeah, sorry, there's it still on the bottom left-hand corner. That door is just a walk-in door. The actual loading doors are the two on the right-hand side, where the trucks actually back up. And then also this garbage that you see in front of you, every tenant actually handles its own garbage as well. So it's really, from a landlord perspective, it's a complete hands-off. So I think that's another attractiveness that this niche is showing us, that the tenants is really their own business, their own operator of their own space. And we as landlord really just have to look at the exterior and obviously the roof, which we specifically focused on. And then what you can see over here, the other thing that was very attractive for us was the fact that they very recently spent a lot of equipment or money on equipment on some capital improvements. So you would see the HVAC units, which is a major cost, was basically just done now. The fire hydrant system, that's one of the things we checked while we were there. It's active, it's licensed, it was checked by the fire department. So that's all in place. The last thing you want is this thing to burn down and not have that sorted out. So that's done. And then I think the parking lot outside was in a very good position, or very good condition. And then I think the only major other, apart from the HVAC unit, the only other major expense that landlords like us would encounter is the roof. And therefore, you'll see the roof has been done. The life cycle of these roofs are typically 15 to 20 years. So we're pretty much well covered. So, you know, from our perspective, it was just unbelievable to find this type of opportunity. And we're finding some more like this. It's incredible. So from a rental perspective, you'll see the rental per square foot is the key metrics that I'm looking at. You'll see there in PFS, like we call it, per square foot. You'll see roughly about $11 a square foot. The market is just about 12 and a half. So on average, it's lower. You'll see the first tenant there is at $8 a square foot, but it's a very good reason for it. Hold that thought. I'll get to that just now. And then all of that has got triple N leases. The escalation is in the region of 2.5% on these. It varies across all that. So we haven't achieved the higher 3% that we wanted, but the rent is below market. So it means that we're well positioned if there is going to be a problem with one of the tenant. All right. Yeah, then I think... yeah, look at this. The tenure of this specific tenant is 26 years at the property. And that's one of the reasons why the rental rate hasn't actually caught up with the market, because the escalations were at a certain level. So, but needless to say, this is a fantastic tenant in the sense that it's servicing one of the largest distributors of fire alarm products, which is Honeywell. So anybody that knows anything about fire alarms and business building systems knows that Honeywell is a fantastic, or one of the three major players in that industry. And then here you can see the logistics that they have to deal with. They have to feed all those states in that area. Therefore, the highway logistics and the backing up of that is necessary. So, yeah, a long tenant, and you can see the lease only expires in 2031. This tenant, surprise, surprise, a little healthcare tenant in the building. It actually got a pharmacy. The photo on the left-hand corner shows the actual door where it's a clean product. They actually buy the raw material and actually make up the pills for the patients. This service, a very growing niche in the United States of home care, and they distribute a very large area from this actual center where they make up the actual pharmaceutical products for the home care people, and the other branch or other division of this group actually have nurses that's servicing and helping people at home. So from that perspective, it's a huge organization. You can see it's Advocate Health. We know it from other places, like for instance near Tampa, where we also deal with this group. So from that perspective, very nice. And also, surprisingly enough, they had to get a certificate that's licensed for this building for that pharmacy. So a batch of pills a night is around about $250,000. So they have also actually increased their security at this building specifically to make sure that this product is properly secure. And again, look at that, 25 years at the same place. Lease expiry 2028. I think we don't have a problem there. I think they've got 2 options to renew. So from our perspective, this tenant is definitely staying here. Yeah, this is was an interesting little group. They are actually got 3 types of business in this building. The first is they actually are plastic extrusions, and they basically create small components. Most of the ribbon plugs and all the fittings on electronic circuit board they make. And they basically have, the first business is actually they create the actual extrudal molds for these machines to make specific products. So they design it all in-house here and they actually make it. And then secondly, they're a very large importer of this equipment from China. I don't know how long that's going to last, but long story short, they actually assemble these units and then they ship it onto other manufacturers that then manufacture on their own side. And then on the left-hand or right-hand side, some of the raw products that they use to actually create those plastic molds. And so this property or this group is actually, since they started in this building over time, has actually increased their footprint. So it's a growing business. And so from that perspective, a very steady tenant that I think is actually could grow if there's a problem with the other tenants. But needless to say, at the moment, the building is 100% occupied. Right, this is communication systems. They basically deliver these IT systems, and it's really the hardware of it. A lot of legacy companies that has or products that they are servicing, specifically for security, voice over IP and communication equipment. And they really are basically supplying and delivering this across almost the nation. So again, logistics from their perspective is pretty good. They have a few offices, but this is definitely one of their major hubs in the north, let's call it mid-north of the United States. And you'll see the other one is in Phoenix, Arizona. So they really split up the country to actually basically feed and distribute east and west. Hence the logistics for their perspective is quite important. So from a deal perspective, you'll see we're purchasing it just over 6.1 million. From that perspective, we're very happy with that price. It's 8.24 cap rate, like I said. That really helps us. At the moment, we're sourcing the debt with our partners. You'll see that we're basically looking at about a 60 LTV. The likelihood that that's going to increase is there, but we like to keep that debt coverage ratio. For people that don't know, is we just want to make sure that the net operating income really covers the service of the debt 1.6 times. That means that it's a pretty strong debt coverage ratios. Most of the banks at the moment requires us to have roughly about 1.2. So from that perspective, that's in place. We are on track to getting a loan, interest rate loan. We budgeted on 6.4%, but I think the odds of the rate decrease coming in September is now greatly increased. So we expect that to come closer to 6.25, and that will just make the deal stronger. We are 50-50 partners with our partner, and you'll see we're bringing 1.5 million and they bringing the rest. So both of us are operating as the co-general partners, and we are bringing the equity from both sides. So we're evenly yoked. So from a deal perspective, we are both managers on the deal, and our operating agreement in such a way will ensure that we have control over bank accounts and maintenance and management of this property like we always planned. Over to you, Martin, maybe just to discuss the portfolio view.
Yeah. So as Michiel has shown, just in terms of the deal itself, when Michiel talks about an 8.25 cap rate, what that means is that a typical deal in medical or alternatively in industrial would trade in a range of between 7 to 7.5, which means when you talk about an 8.25, it's the return you get on a deal. And so if you bought a building at $10 million at a 7.5 cap rate, you would get 750,000 return on your money. At an 8.25, you're getting 825,000 return. So the higher the cap rate, the cheaper the price that you pay. And so we've got it at an incredible price, basically by jumping on the deal, going to it and signing it straight away. The next deal also that we're looking at is a deal, just to give everyone a snippet, it's under due diligence. And that deal, for example, is in Pennsylvania. It has a 15-year lease to the dominant player in the entire state, who then 3 years ago acquired the second biggest player in the entire state. And so it's a company that's been around 35, 40 years. And again, 8 cap rates, incredible deals, incredible opportunities. And we're super excited about it. And literally already, with our network and between our partners, Mark and Ron, with our reputation over here of when we put in an LOI, we move forward, we close deals. They're now throwing a lot of deals our way. And again, what I'm really enjoying is being able to really just talk to the seller directly and to be able to engage and get these deals as part of our portfolio. So I think we're going to snap up this portfolio very quickly. I think it's going to be able to, the most important thing, generate dividends that are stable and consistent to investors. And that is our strategy and that's our goal. And you can see if you're diversifying on a strong building that's pretty much been 100% leased for a long period of time with these kind of tenants, you can feel that your money's working on a consistent manner. And so will we believe the rest of the portfolio. And so you can see the numbers over there. So as we start to bring this to a close and we can go into Q&A, our view is very clear. I'm going to take the first two at the top, and then I'm going to hand over to Justin. And I believe that it's just absolutely the team. We've finally in a position now where we're seeing these amazing opportunities. We've got the team, the tailwinds are behind us, interest rates are coming down, and that's the perspective from our side. Justin, over to you to cover the last two and start to wrap things up.
Thanks, Martin. Thanks, Michiel. So I think, for a while, it's been difficult to get excited about healthcare. We certainly started off super well with healthcare. It's become very difficult, as you heard John Trouble speaking about earlier. And I think for the first time, I'm super excited about the opportunity of investing in the US. We definitely pick up lots of different views of what's happening in the US, but the one thing that we can be certain of is there is going to be an increased demand for industrial space. And the amazing thing is that there is very little industrial space that is available. The vacancy factor is super low, within the 5%. So there's not a lot of space to be absorbed. And we're certainly not talking about the 100,000 square foot factories that will be built for the major manufacturers. We're talking about all the suppliers, and that is what is called small bay industrial. And small bay industrial, the vacancy in many cities is actually zero. The supply has already exceeded, the demand has already exceeded the supply. And so you've got this very unusual situation, guys, that there is increased demand. The supply hasn't caught up. And we have 2 buildings under contract that are already both over 8% cap rate. You would never find something at 8% cap in the healthcare space unless it was a building that really had warts on it. So this is absolutely the right product at the right time. And then I want to just talk a little bit about the strategy. I think that some people say they really like the idea of being in one building because it's fantastic. You know the building, you know where it is, you know who the tenant is, etc. But we have so learned this problem that you do not want to be in a single building. You want to have diversification. And especially as a lot of these small bay buildings are effectively single tenanted. Our plan is this. We're going to take these things and we're going to put them all together and create a nice little diversified portfolio, which will be super attractive to someone to come and buy. And I think that is the plan. It is a 5-year timeline, but the other thing is that we are now chasing IRR. We want to get a higher return. And the best way of getting a higher return is if we can squeeze that 5-year timeline down. And coming back to the timing, once again, interest rates coming down. Happy to answer those questions. It's going to happen. Supply constraints. Absolutely. with interest rates coming down, cap rates are going to come down. You're not going to get buildings forever at an 8 cap. That's absolutely for sure. So all of these things are going to happen all at the same time. And that's why we say right time and right strategy for today. So guys, thank you very much. We are open to questions. Please pop your Q&A in there. There's an enormous audience watching tonight. So let's get to the questions, and I'm sure we will be able to fill up the gaps through answering those. So
Yeah. There's a first question here about how can you get an IRR of 8 cap with 2.3% increases? Won't you be borrowing above this? Muriti, the situation is like this, is that if we buy at an 8 cap and our interest rate is roughly, let's call it 6%, we got a differential of 2%. So that basically means that if we then take the average of our capital cost, which means that 70% or 60% of the capital is at 6%, and we have got the rest at a 7% return from a cash on cash perspective, the average cost is actually below 7. So from that perspective, we can easily actually create that return. So it fits, and that's one of the reasons why we're not buying medical at the moment, because the interest rates to almost a month ago was still at 6.8, and the cap rates for deals in the medical space is roughly 6.8 and 7. So there's not a differential to that interest rate, and therefore we don't get the cash on cash return. That's why we're so excited if we can buy at an 8 cap with the interest rates most probably going down to 6. So from that perspective, it's a very good opportunity.
Michiel, I'm going to jump in and take the next question from TD, who asks, industrial properties are linked to GDP, whereas healthcare is less dependent. And I think the one thing is that everything is dependent on the performance of the economy. But remember, the fundamentals of real estate are all about when you buy. If you buy right, there's very little downside and a lot of upside. And so in this particular building over here, we are buying at well below replacement, well below price replacement. And the second thing is that in terms of where we are in the US at the moment right now, I can tell you now, I'm part of a forum, and we had 3 guys on the panel this week. Each of them are running businesses as their own family businesses. They've been involved anywhere from 10 to 25 years. And each of them is now starting to expand their own production in the US and try and remove the reliance on overseas because of things like tariff, etc. And so they'd rather just be holders of their own destiny rather than dealing with volatility. And remember, these kind of businesses, they've been through the ups and downs for literally 10, 20 years. They've been through all the cycles, but it's all about supply and demand. And at the moment right now, everything is pointing in the right direction. And we don't intend to hold these buildings for 10 years. We're getting in, we're going to aggregate, we're going to hopefully get the NOI up, which is the net operating income, and then you sell it with hopefully cap rate compression also. And that's how you get to the IRR. The previous question alluded to 8%. If you're already getting 7% cash on cash, and you're getting then a capital gain, those two together make up what's known as an IRR, your internal rate of return.
I think the other question was with regards to what is a track record of our partners. I think we've got a long track history of working with partners. So one of the clear things we did was check out their track record. These two individuals has got a more than a 10-year track record in the industrial space. They have amassed a massive portfolio. Martin, I think you will.
Michiel, I want to jump in here. That's slightly incorrect. I've known Ron and Mark a long time. Their current track record and structure is 10 years. They've been doing this. Mark's been doing this literally since he left school. That's 30 years. They were part of a company called Reich, which was one of the largest M&A players in the US. They bought all industrial, they constructed, they managed all of them, and they literally then exited Reich and started their own structure. So they have an enormous network and a track record in doing this very, very successfully. And so we're super excited about doing deals with them. In fact, the interesting thing about this is that Michiel, and I have to say, we're very proud of it, they actually found the deal, and Michiel found the deal at the exact same time. And we got online to compare, and we found we're talking about the same deal. And when that happened, we both liked it. We immediately, the same afternoon, got all the brokers, struck the deal, got on a plane, went there. And that's how you find these opportunities. The bigger players just move too slowly. It's across every business in the world.
Michiel, I'm going to ask you if you'll jump in and just talk to David's question. This is one of your areas of expertise. So having done this for so many years, perhaps you can talk him through his questions. I will start off just by adding, David, that we have inserted the entire fee structure into the actual documents that we can share with you, because obviously it's not just the fee structure in the Seychelles, it is the fee structure that goes all the way through the Accretiv Hybrid Fund 2 LLC that you can see in the blue block that Michiel will explain to you when he explains the tax structuring and below. So I think that we've taken all of those fees and we've consolidated the total fee structure, and we put it into the document for the first time. So for clarity, it's all in there. But it's absolutely market related. Michiel, perhaps if you can talk to the withholding tax and the probate exposure, etc.
Yeah, so I think the structure, David, we made it extremely simple. You'll see the hybrid fund 2 is the, let's call it the main fund, and that you can basically look at as a big combiner of the US investors coming directly in on the left, on the right hand side, and then the hybrid holding corporation that comes from the top. And that hybrid function is really having a specific tax structure that we deal with the offshore company, which is in this specific case in the Seychelles. And with that, we can deal with the withholding tax. And you as an offshore investor do not have any exposure to any US authorities or regulations, specifically the FATCA and the FINRA side of things that most investors fear. So we have perfected that with our tax advisors over the last 10 years. So from that perspective, it's a known way of doing it. And we've just created this fund structure. You would see it's specifically an independent structure completely away from our existing medical structure, so that we can have these two, let's call it legs of investment for investors, so that they can have the diversification over both medical and industrial.
Justin, I'm going to jump in and ask you the next question, because it's actually to you, which is this part of a broader strategy to bundle both healthcare and industrial together? Or what does this mean for healthcare over time?
No, I think to answer that question, you absolutely don't spend 10 years in healthcare and then walk away from it, guys. We still love healthcare. We wish we could buy buildings, but it's just impossible to compete in the market at the moment against the REITs, etc. And there's just no transactions happening, and we are just unsuccessful on every single bid. So the fact is that healthcare is not, the time is not right now for healthcare, and so we are creating an entirely separate structure that is the industrial. And just to be absolutely clear, what is our plan with Accretiv Plus? Our plan with the healthcare portfolio is to prepare it for sale. And that means that if you find a medical REIT or a medical institutional buyer that wants to acquire that portfolio, they don't want to acquire that portfolio mixed up with industrial. The value of the portfolio is that it is medical. So you want to sell a medical portfolio to a medical buyer. You don't want to have a mixed up portfolio of some industrial and some medical. So that, I hope, explains it. And then, of course, the other thing that perhaps is worth sharing is that there is some surplus money in Accretiv Plus, and we will make an investment, and that means that it is purely an investment into the Accretiv Fund 2, just to park that money in the meantime. So I think that we do not intend to be to be actively involved in the industrial, but we will park some of that surplus money there in the meantime. So I think I hope that answers that question.
So one of the next questions, Michiel, is, or Justin, in fact, we can throw this to you. Justin, what's the minimum amount for people to be able to invest?
So this is a very good question that I think we haven't spoken about yet. Like our normal investments, what we call a B-class investor, that investment minimum is $5,000, and that's purely to get going on the exchange. But we do have a very limited pref, and the idea is we do understand that this is the first building of the portfolio. The pref is for those that wish to invest $25,000 or more, and that is an 11% IRR pref. So during the course of the investment, you get the same dividend or distribution as everybody else, which is 7%. And we're very confident that the 7% could even increase in the future, but you can do your own math, and you can see that the building can certainly generate that and more. So yeah, and then at the end on disposition, and I think I must just say that at disposition, we believe that at the property level, in other words, at the lowest level on that chart that you saw just now, there is a 15% IRR that this property should generate if we get some cap compression. And I think that that is obviously super important, because that flows back up to the Seychelles and makes sure that you can get your 11% plus IRR. So an 11% pref IRR for a limited amount of investors who are investing over $25,000. And that's something that we've included there just to kickstart the fund.
If I can just jump in now, one of the individuals also has asked about the track record of the partners. Happy to share it offline with you. They've got a very impressive track record. Just to give you an idea, they did one building alone where they leased up 700,000 square feet. One of the billionaire offices in America actually backed them on a deal for $55 million equity. and they don't get backed unless you really know what you're doing with that kind of quantum. You know, one of the questions which someone asked when they actually came online is, so how come that family office doesn't then back you again? And the reality is that family office doesn't cut a check below $50 million, if you can actually believe that. They're just so big, some of these family offices and institutions. Not to mention also the fact that when they do that, they also want probably 90% of the economics, or certainly the bulk of it. One of the questions I'm just going to quickly handle, Justin, is around the fact that somebody asked the question about the liquidity in the existing medical fund, and you know, in terms of what do we intend to do with it. And it's a great question again. You know, right now, again, it's swung in the last week again further to the fact that the US, there were 2 articles that came out yesterday where they expect now, certainly the majority of the individuals, that there will be a rate cut. And so this is what we've been waiting for. We were told last year by the Fed, not by anyone else, but by the Fed, that there would be 3 rate cuts this year, which is 25 basis points per rate cut, which would be a minimum of 0.75. What happened was, as the Republican Party came in and Trump came in, they started with the tariffs, and that obviously caused uncertainty. And so they had to postpone those announcements or the cuts until they felt that there was no major impact that was going to derail things. I think certainly this week you've seen, if you haven't seen, go on and have a look at the US inflation update. You'll see it was quite benign. It wasn't anything out of kilter. And so now they're saying it's almost overwhelming. But I just have to tell you, there is an ongoing fight every single day in the US. Literally, if you turn on any TV channel, it's the fact that it's the government bashing the Fed to say, you've got to lower rates, lower rates. We want this economy to grow. You guys are holding it back. You're taking too long. And so that is something that I think is certainly gathering momentum. And that's the reason why we're so bullish.
Yes, maybe I can just answer Franken there. Will Accretiv procure 100% of the building? We basically are procuring half of the building. So from that perspective, we have a partnership. So if you look at the screen at the bottom, there's a, let's call it IndieX, that would be the SPE at the bottom. And that IndieX at the bottom will basically, half of the investment capital will come from this fund, as we've shown it here. And the other half will come from the Blueprint partners, as we alluded to. So that's how we do. On a day-to-day management, Blueprint partners will do the day-to-day management. However, we will be involved in any case because we will have joint management rights on the account. So it's a full 50-50% partnership on that side.
Michiel, I just want to also mention, you know, it's actually been fascinating to speak to all individuals. You and I have gone around and spoken to everyone. We've been so proud to say we've got our own in-house property management team. We do everything. And it's been a consistent message. Everyone is like, Martin, you might go to a medical building and everyone wants to talk to you. In an industrial building, no one wants to talk to you. It's an owner. He's running a factory. He's busy. Go there once a month, say hello, find out if there are any issues. But it's not the same. It is so low touch compared to what you guys have been used to for the last 7 to 10 years. I also just want to mention one other thing, Justin. Zubair, actually, I hope I pronounced your name correctly, has asked again about an exit strategy and the current deals we're in. And I just want to reiterate again, we would love to sell more of the deals. We would love to put them on the market. But the problem right now, as you hear, is that with rates coming down, people are saying, just wait, you know, just wait a couple of months and be patient. The second thing is, if you put them on the market right now, we've seen the bigger players are saying, we want to get it at a hell of a discount, and we've got the money and we're going to offer you a discount. The players like ourselves are saying, we're not selling unless you pay us the correct price. And therefore, Justin alluded to possible activities and larger players like the REITs. And we will simply assess over the next 6 to 9 to 12 months where we go. We love medical. We wish we could buy it at the right price. But conversely, there's this disconnect between buyers and suppliers, whereas at least, thank goodness, in industrial, that doesn't exist. You make a guy an offer. And also, we haven't spoken, Justin, about the sellers. You make a person an offer. We found a lot of buildings where, you know, the father used to run a factory. He sold the business now. The kids are inheriting it. They're getting $6 million. In their world, they just want to sell it and go and enjoy their retirement. They're not as fussy as the kind of sellers we used to.
Yeah, I think I will just take, oops, Sonia, you took Sonia's question away there. Just coming back to Sonia's question, once again, I think there needs to be some clarity there. Guys, we set about consolidating this portfolio at great pain at the end of the end of 2023. In fact, we effected that in 2024. And the intention was, and we said all the way along, that we would like to take the medical portfolio, wait for the right opportunity, which will be within 5 years. And I can tell you right now, we would actually like to get out sooner than that if we can, and then offer it to a buyer of medical buildings. And I think that is still absolutely the strategy. We want to try and not break up the portfolio, because we believe that there will be a premium that will be paid for it when the time is right and when the rates are perfect. And I think that there's nothing wrong with the conversation right now of considering what would happen if we took it to the market next year when rates come down by let's say 50 basis points. So I think that we absolutely are aware that some investors that we rolled into the portfolio would like liquidity, and I think we're all in the same position. So if we can find an early exit, we absolutely will. For you, Zabir, you can be absolutely sure of that.
Justin, I just want to start to wrap things up and talk about cash flow, liquidity, and earnings for people in this hybrid industrial fund. And the one thing we've seen over time is it's a very liquid niche in America. Every single person, it's been such a breath of fresh air for us because, in medical, you speak to 100 people, you're lucky if 1 or 2 people are dealing in that particular niche. You speak to them about industrial, almost every single person in the US has either owned a building, wants to own a building, has been involved in industrial. So it's a very big area. So there's a lot of liquidity and changing hands. And so in this particular fund, if we happen to get a building, we sell a building, we make a good profit, somebody makes us an offer, because often you find the owner wants to buy the building, or a new person comes in and they want to actually own the building, and they'll make you an offer. And so in that particular example, we will be returning capital to people. Nothing would give us greater joy than to return the capital to them. If they want to reinvest, it's good for them. But our strategy is very clear at this point. Go in, get these good buildings, solid producing income, aggregate them, exit timely, and that's it from my side. Thank you very much for joining us tonight. I hope we've answered everyone's questions.
I think the most important one that we haven't answered is you got a limited time to do this opportunity, Justin. Maybe you can give us
the question. Michiel, you were getting rid of the questions faster than they were being answered here. There was a question about the timelines, Michiel. So let's talk about those. So both of the buildings close in the first week of October, which means we have to call for funds now in the next 2 weeks. So
I think investors, please take care of this. You've got 2 channels to invest in. We got the normal Seychelles channels that you from the UK, I saw a question there. Also, everything elsewhere in the world can go in there quite quickly. We really need that funds by the latest, the 3rd week in September. It takes roughly a week and a half to make sure that we can have everything in place like it should. It will go into an escrow account, which is a third party handling the money. We're not handling the money ourselves, and we will only release it to the deal if it closes. If it doesn't close, it will come back like we have been doing for the last 10 years. So nothing has changed on that front. For LLC investors, we will have the opportunity for you to invest directly in the United States into the fund. We're really not going to open it up for individuals into the individual deal. The whole idea, like Martin said, we want a diversified portfolio of 10 to 15 of these properties. It will be about a 50 million deal. So I think we can get that quite quickly. So from that perspective, you've got an LLC channel if that is your wish, but most of the investors still do the offshore side. That's in place, and it's fairly easy and simple to do. But the most important is if you want to get into this, let's move quickly as a group to get this done. We hate to say no to any of these opportunities, and me and Martin has found another 2 already. So we are like racing horses ready to run now. So we need to get some funds in, and the quicker the funds come in, the quicker we can buy. The opportunity is now for the next 6-7 months, and so from that perspective, let's not miss this opportunity.
So I just want to say to everyone, apologies for assuming we were going to close. Justin and I are extremely cognizant that we never like to go over an hour. Justin, I think literally in the last 6 years, this is probably a record for us. That questions are still coming through, but again, 1 or 2 of the individuals have said, very interesting opportunity. I know that they are larger investors. If you are a larger investor and you want to take some kind of participation in the prep that Justin spoke about, please contact Justin and the team. They'll explain to you how it works and what the requirements are. Justin, over to you.
Thanks, Martin. Thanks, Michiel, for your time, both of you. And Anil, I'll give you a call in the morning because I see you still asking questions there, but all good. We will absolutely be able to accommodate you. Guys, thanks a lot for joining, and we'll be in touch. Thank you. Good night.
Good night.
Bye-bye.